Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at SignatureFD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. We are back with another episode of the Vet Worthwhile podcast. James Yost, Travis York, as always. Our guest for today is some of the SignatureFD top brass, Chief Investment Officer, Tony Welch. Tony, Happy New Year. Thanks for coming on. How are you, man?
Yeah, Happy New Year to y'all. I think this is my third appearance on the podcast, and I'm excited to be here. It's always fun with you guys.
Love it, man. Well, we appreciate
Tony,
your time.
This is not Delta. We don't offer frequent flyers. There's no bonus for multiple appearances.
Oh, well, okay. I'll keep that in mind later on this year, Travis.
Yeah, there you go. So, Tony, we wanted to have you come on as we kicked off the year on the podcast, just to do kind of an update, where we've been, what happened last year, what were some of the common trends. We'll get to the questions in a minute, but also get into, nobody has a crystal ball, obviously, but what are some of the themes that we're seeing that are evolving that we anticipate are going to be prevalent this year, not only within capital markets, public markets, but also down to our clients, which are small business owners largely. So with that, would love just kind of a brief overview of some of the most important market trends and conditions that happened in 2023.
Yeah, if I were going to recap 2023, really in one word, I would just say reversal, right? So it was just a reversal year last year. If we think back to 2022, that was really characterized by high and rising inflation, and then the Fed's fight against inflation. They had one of the most rapid interest rate increase cycles in history. And because of that, in 2022, we had a 25% bear market. So that's actually quite painful if you think about bear markets that don't overlap a recession. That's a pretty deep bear market for one that didn't overlap a recession. And then you think about kind of other asset classes. The Fed hiked rates, bonds also fell about 13% in 22. So that was definitely a challenge. Spiking inflation, tough monetary policy, bear markets in stocks and bonds. But then you think about 2023. We went into the year with economists extremely pessimistic on growth. They were actually on net forecasting a recession, which economists rarely do. And market strategists were forecasting for the market to be down last year for the first time since at least 2000. Typically when sentiment is that one-sided, the market's going to do whatever it can to prove the majority wrong. And it sure did in a big way. So in 2023, last year, what we got easing inflation. We got a peak in interest rates, so bonds did okay last year, and a 26% recovery in stock prices. So that's really the broad picture. It was mainly a year of recovery from the 2022 inflation surge.
Well, I think probably it's good to hear kind of the recovery sentiments out there. Do you feel kind of just in your view, Tony, that this is like soft? There's not. Kind of what are you hearing as we head into 2024? Is there optimism? Is there stabilization? Or is there just general kind of overall pessimism coming from the people that you spend time with?
I still think that there's this sense of, man, there's a lot of bad things going on in the world, so there's still just kind of this pessimism. The headlines are still kind of negative. Now you've got these issues around shipping, in the Red Sea and what have you. You've got the conflict in Gaza. You've got an election year this year. So, all these things that are going to be front page news kind of work themselves to kind of keep people more along that pessimistic line. And one of the things that I think you can look to is how people are allocated. You take a look at how they're invested. And partially because money markets actually yielded something last year, people are very highly allocated to cash. That's one of the biggest things that we've seen in terms of shift in investment strategy. So people are happily kind of grabbing that 5% for cash and kind of avoiding the stock market. So I'd say that there's still kind of a general air of pessimism right now.
Yeah, that's interesting. I can definitely get that kind of feedback as well as I'm out talking to people. So last year, going back to that too, so we saw quite a reversal in some of the trends that we had seen the prior year, at least in capital markets. Ending 2023, though, for small businesses, like what changed for a small business owner during that time period? You and I and our team, obviously, we do a ton of work and research on public companies, but a lot of our listener base is actually small business owners. So like anything you could share for small business conditions in 2023?
Yeah, and so we invest primarily with publicly traded companies, right? We do some things in private equity, and I can speak to that a little bit later. But where I really keep a pulse on the small business community is for trends in the labor market. I mean, we have to remember that companies that employ 1 to 50 people make up the lion's share of employment in the economy. So it is really important to keep up with kind of the health of the small business community. And I think what was interesting and a challenge for 2023 for small business owners, we know we got this rally in really mega cap companies last year, but you look at kind of smaller companies and businesses, those stocks did not perform last year very well. And the reason is because they experienced some challenges that the larger companies had largely moved past. So if you think about kind of the hiring environment, right? The large companies were able to fill their hiring needs in 2021 and 2022. And that was largely at the expense of smaller businesses. Smaller businesses had a hard time being competitive in the labor market versus the large businesses. But last year, what we saw was saw large business job openings start to fall, and smaller businesses actually started to staff up again last year. Now, the issue with that is they were staffing up in kind of a higher wage environment, right? Wages have come a long way since 2020. So what ended up happening is that kind of created a headwind for profit margins on small businesses, especially in their labor line item. So that was something that was quite a challenge. Then the other challenge for small businesses is we know they tend to be more levered to short-term financing needs. And we saw credit availability contracting. We saw the cost of credit was rising. And that was a challenge for small businesses as well. Fortunately, I think there's some good kind of green shoots that both of those things should ease for small business here in 2024.
Interesting. How do you see, I mean, because like I kind of hear a lot, Tony, just along that vein of like some of our veterinarians feeling almost like a disconnect sometimes when you see like, again, this is going to be really general and broad, right? But like we just came back from a big veterinary conference and you heard, well, like the markets are going up, but like my visits are down or clients aren't spending as much. Is that like how do you kind of see that and how do you help veterinarians connect? Why may things be positive in the market and not so positive inside of their business?
Yeah, and that really does speak to the disconnect between kind of what the markets are going up because the very large companies tend to have a lot of cash on their balance sheets. Higher interest rates are good for them. They're actually earning interest on their cash. And they've largely been able to boost productivity to control kind of labor costs. I think when you think about the actual spend numbers, Travis, is you're starting to get to the point, look, wages have started to soften, right? So wages are still growing, but wages have softened. Like at their peak, wages were growing at 6, 7%. Now wages are growing 4%. At some point in time, there's only so much in expenditures that can be passed to the consumer before people start making more difficult decisions, right, in terms of where they're allocating their dollars. And I think you are kind of seeing a little bit of that where wages were very high. and we could continually kind of pass on costs and people would pay it. They would continue to spend kind of in all their lines of spending. And now as the job market is normalized, wages have started to come to a more normal level. I do think that that kind of creates a more difficult decision tree for kind of your average spender.
Interesting. Kind of just following on that, right? Like if I'm a hospital owner and just interested in kind of tracking that consumer sentiment and how it may actually impact decisions that they make inside my exam room, or how I think about pricing strategies. You kind of, I mean, and I know this is not your area of expertise at all, Tony, but like what I'd love to get your insight on is, where do you go to look to kind of get some of that like consumer confidence information? What's a couple good data points they could use as they think about, should I raise prices 3%, 5%, or maybe not at all?
Yeah, I mean, I think that there's plenty of good, like the NBER, right? That's NBER, reports things like consumer confidence and that type of thing. I think the thing that's interesting is consumer confidence has actually improved. Throughout 2023, it improved, and now it's mainly because inflation was easing. So I don't know that it's kind of a one-to-one relationship between consumer confidence and what we can do on pricing. It's really kind of feeling out, the customer's ability to take on, higher price levels. And at some point, that kind of tops out. And I do think that something to watch for that is kind of observed wages. The Atlanta Fed actually has really good data, real-time data on what's going on with wages. And you can really only boost prices, especially in the service industries, consistent with what wages are doing.
Yeah, that makes sense, Tony. Back on the private equity things, you had mentioned this, and we've talked about how the market did really well in 2023. Interest rates have started to kind of come off those highs that we saw late in the summer. Can you just speak about what we see going forward for the trajectory of interest rates, and maybe even tie that into the private equity market? And the reason I want to touch on that, a lot of our hospital owners who have not sold to anyone yet, but are considering selling corporate, I want them to understand the relationship between public market valuations, interest rates, the private equity backed consolidator groups with which they're selling to, and how all these things are connected, because they're all based on kind of the same market dynamic. So what are you seeing in the private equity landscape now?
Yeah, they all are certainly interconnected. The public markets are going to give you more volatility. You're going to get more real-time information out of the public markets. But at the end of the day, all investing is a function of the price you pay for something, the fundamentals along the way while you hold it, and the price you sell it for. So in terms of, if you think about the interplay with interest rates, so first and foremost, the more likely path for interest rates is flat to down this year. And that's just because the Fed is telling us that their preference is to cut interest rates this year. Now, the market thinks the Fed's going to cut a lot more than the Fed thinks the Fed's going to cut. But the Fed is already telling us, we think we're going to cut interest rates this year. And if you think about lower interest rates help in a couple different ways. One, it gives you better access to leverage. So the private equity players have cheaper leverage with which to work. Second, it really helps drive multiples higher, because if you think about valuation is really just a discounted cash flow exercise. So if you have the same projected cash flows out in the future, but you have a lower interest rate, then they're worth more today. And then it tends to, because of that dynamic, it tends to get exit multiples higher as well. So lower interest rates would be probably a major boost to private equity activity this year if that does come to fruition.
Got it. And does that, are there bigger impacts, Tony, on, say valuation higher up, right? If it's a larger group of hospitals, say a consolidated group of 100 hospitals, does interest rates impact that more than, say, like a single hospital that may be looking to sell? Or is it all kind of generally a proportional, like similar impact, just based upon demand and the desire of people to put money out and create returns in a lower interest rate environment?
I think it's going to be a similar impact, Travis, because I mean, you think about the PE industry in general does have a lot of cash sitting there to invest and spend. Now, a lot of that cash is concentrated in really large PE firms. But a lot of what they do is they're buying businesses up market from smaller PE firms. So it's all kind of a chain that works together. And I'm not so sure that just being a single practice or, you know, a larger practice is, I think it's going to be pretty correlated.
Okay. Let's talk about technology. So with anything happening 2023 from an emerging technology standpoint that you think could be kind of innovative to us for like on a small business operator, anything that you're seeing in the larger scale that you think is going to make its way down to the small business?
Yeah, so that's a really good question. So I talked to I've been in the room with CEOs of some of the largest companies globally, and I do think that some of this tech is going to trickle down, particularly when we think about artificial intelligence. You know, I really think this is something that we need to pay attention to, that it could be a huge productivity game changer for nearly every industry. There's going to be application. So I'll give you kind of an example in my own work, which is not applicable probably to the vet space, but my point is finding creative ways to utilize these productivity enhancing tools. That's going to be key going forward. So for instance, with AI today, I do a lot of content creation for our clients. And what used to take me kind of a day to write, I can today sit down, craft an outline in 30, 40 minutes, feed it to an AI tool, and I get back a pretty well-crafted draft that I can start to work with in that content. And it's probably at least half my working time, allowing me to focus on other things with that extra time. Or we get things like we get manager letters from the various managers that we invest with. We get research from outside research providers. We can scan those things into an AI system, and we can have it scan all of, you know, just layers and layers of content for key themes or important information. So in essence, I can use one analyst to do the work of a couple analysts a few years back. And I do think there's going to be applications to the medical fields and the veterinary field that you're going to see some advancements that help with diagnoses, treatment protocols, our ability to perform complex analysis. That's going to greatly improve through time. So that a lot of that is getting generated by the larger companies right now, but I do think the benefits are going to be accretive even to smaller businesses through time. And that kind of the last thing I would say about the AI boom is human beings, we have a really hard time where our brains work in a linear fashion. You know, we think about 10 plus 10 equals 20. But when you have a technological advancement like this, you may be thinking about things in terms of an exponential growth curve, like what's 10 to the 10th power type of thing. And I think that there's going to be some breakthroughs there that could be really exciting.
No, that's a great point, Tony. I mean, because we're already starting to see some technologies enter the vet space in that realm related to like medical records, right? So like you think about all the time that doctors spend writing up their records.
Yeah.
And now with AI, there's already some technologies that are coming that just listen to the conversations and record your medical records for you.
Yeah,
that's pretty transformative. I mean, I've talked to so many different doctors who've spent so much time after their shift, you know, cataloging all their client notes and client records. So that's, I mean, that could be something that could save a ton of time.
Just that, guys. What I would be interested in deep diving with y'all is what you're seeing in the vet community from like a true kind of technological perspective in terms of even procedures and stuff like that. I mean, there is going to be some technology advancements, I think, that really benefit the industry.
Yeah, and it's an interesting balance, right? And like, I mean, again, it almost takes my head to like two places, right, Tony? Like, one, we've talked a little bit earlier about just like some maybe consumer contraction in spending. And so then as a business owner, one of the things you have to focus on is like greater efficiency, where like historically, like over the last couple of years, like especially in veterinary hospitals, you've been able to like grow just via like fee increases, but like how do you implement like this technology and AI in reducing expenses, increasing efficiencies? You know, and I'm assuming that probably applies across all businesses, you know, but do you think there's going to be any trend as maybe some consumers kind of digest inflation and maybe some stabilizing wages and probably longer borrowing costs than we've had, right? Like they may come down from where they're at, but probably longer borrowing costs than, you know, we've had over the past 5 years. Do you see businesses just focusing more on expense and efficiency like issues to drive value and cash flow?
I think that's exactly what to watch for. I mean, you think about how the big companies have done it. They've been able to boost their free cash flow margins. And I think that is what's going to drive value going forward. I mean, at the end of the day, I mentioned it, maybe not in a very eloquent way, but cost increases to drive revenue are only going to go as far as kind of wage inflation takes us, which is going to move kind of along the line of economic growth, which, let's face it, economic growth around most of the developed world is pretty slow. So I don't think that top line is on now, of course, some practices are going to grow their top line like gangbusters, but on net, I don't think that top line is going to be the way to unlock value. I think the way to unlock value is getting more of that revenue down to the bottom line.
Yeah, it seems like that's going to be the trend with some of this technology, and that's going to be the benefit. Hopefully over time, we can see more real world examples for how it's being played out in small businesses, but definitely fascinating nonetheless. Let's talk about 2024. So we've talked about the past year, where we went, even you dug all the way back to 2022, which was helpful for context. What are we thinking for 2024? What are our some of the leading economic data that we're seeing that's projecting forward? What is all that telling us now about the year?
Yeah, I mean, this year's going to be, it's the same thing that we've been battling because we're still in the same economic cycle. It's going to be about inflation. Does inflation trends stay contained? I mean, I think a lot of people are looking for, can inflation fall back to the 2% target? I'm not even sure that matters as much. It's just, can we have stability there? Can we avoid inflation surprises and shocks? Can interest rates remain stable and avoid surprises and shocks there? And if we do, then our outlook looking at 2024 is that the economy has enough momentum to carry us through 2024 without a recession. And if you don't get a recession this year, then we're probably going to see some pretty decent earnings growth. Not just in large companies this year, but also in smaller companies this year, you know. So like I mentioned earlier, a lot of the main headwinds that they had in 2023 are going to abate a little bit here in 2024. And if that's the case, I think you end up, from an investing perspective, you do end up with another positive year, not necessarily bear market conditions. And that it may not, we certainly don't think it's going to look like 2023, where stocks are up another 26%, though it could, you know, we're not sure. But, you know, another decent year without a bear market and some okay economic growth. I think that's kind of what we're looking at for the year ahead.
Well, couple that with, and I mean, I think, you know, kind of one of our biggest questions that we always get, Tony, is just around rates. And I know we've talked a little bit about this and kind of, you know, alluded to the impacts inside of the private equity market. But, you know, a lot of, you know, our listeners are just small business owners. And to your point earlier, don't have a lot of cash sitting on their balance sheet, right? They're funding growth, they're funding opportunity through debt, and they're hearing rates are going down. What are your expectations on, like, what is rates going down? Is that getting back to 3%? When do we kind of feel like, hey, we've hit a stabilized normal rate, right? Because like 3% is probably not a normal rate across history for businesses to be, and for, quite frankly, for the economy to be healthy. So what are you looking to see there to kind of say, hey, we've hit a stabilized point, and I can feel like the soft landing that everybody keeps talking about may be real?
Well, it's tough to know kind of what the what they call it the neutral interest rate. Like, what's the interest rate that keeps the economy in balance, where you don't really have overheating and inflation, but you don't have a recession? It's tough to know that in real time, but what I can tell you, Travis, is it's come down through time. So, if you're looking at data from the 1960s or something like that, where the Fed policy rate may have averaged a higher level, that's probably not appropriate to today. So I'll kind of start with that base where like the neutral rate of interest is lower than it was historically. Now, the Fed thinks that that's about 3% or so. They think that if they've got a Fed policy rate around 3%, you've got inflation at 2%, then you have a slightly positive real rate of interest. And the reason that the neutral rate is lower is we're a slower growth economy. You have to have a lower rate to spur investment activity in an economy that's a slower growth economy. That's just kind of how that works. Now, as for when we kind of get to that level, the Fed thinks they're going to cut interest rates 75 basis points this year. That is already largely baked into longer term rates. So if I look at the 10-year Treasury and that's sitting at about 4, Fed policy is over 5, that's the market telling us that they expect that the Fed's going to cut rates. So the first line of rate cuts, I don't think that does much to move the needle in long-term interest rates. So what I would say for 2024 in terms of our rates going to come down, longer term borrowing rates are probably about where I expect them to be in 2024. Now, if we have a recession, then the Fed's likely to cut rates a lot more and interest rates could drop, but I'm not so sure how much investing everybody wants to do in a recessionary environment anyway. So that's kind of our expectation is, a 4% 10-year rate. That's about right for this year, unless we get a surprise from the Fed.
Yeah, that's super interesting, Tony. I mean, it's something we obviously follow closely. And a lot of the data that I'm seeing, not only on veterinary transactions, but also on broader IPOs and M&A at the larger company, non-vet specific, definitely saw flows slow down significantly last year as interest rates peaked, but we've already started to see a thrust upward and to the right for volume in both of those categories. So within vet and outside of vet, which is cool. Hopefully that continues through 2024.
Well, let me add on to that just real quick, James, because it's a really good point. Because human beings have this bias that we call anchoring, right? Where we were going into this Fed hiking cycle, we were anchored to essentially a 0% policy rate and an ultra low interest rate. Well, now we've kind of seen that interest rates can be much higher than that. And I'll use the housing market as an example. When mortgage rates went from 3 to 8, nobody was buying a house. When mortgage rates were from 3 to 6.5, nobody was buying a house. But once we saw that rates, it's possible for them to hit 8, now on the way back down to 6.5, housing activity is picking up like crazy, right? Because now we've re-anchored ourselves to, hey, rates can actually be higher than this.
Yeah.
And this rate isn't so bad. So I do think that you could see activity, even if rates don't fall from here. I think that knowing that rates could be higher is helpful for spurring activity at these levels.
Yeah, no, I agree. It's a interesting human kind of irrationality that we have. Fun stuff to track. This might be our last one, Tony, and you've already talked about this a little bit. And I know that your research and the data that you're looking at is more broad-based, but I know you guys pour into this stuff deeply, apparently with the help of AI as well, which is great. But what's your read on the current labor market? Just where are we now? And, where have we been? You've talked about it a little bit already, but also if you can hone in on specialized workers at all. I don't know if that's in the data you're looking at, but would love to get your take on that.
Yeah, and it is important to make that distinction, right, between the broad labor market and some of the more specialized, especially in the health industries. But I'll kind of start with the broad labor market. So there's been a lot of normalization in the labor market. I mentioned that large companies largely filled their positions by the end of 2022. Smaller businesses really started to get their positions filled by the end of last year. So what's naturally kind of transpired is open positions have fallen. So we track job openings through a bunch of different surveys. And in all of them, they tell a story that job openings are lower. We also track hiring trends, and hirings are down. And workers feel that, right? Like workers kind of just intuitively know that the pool of job availability is lower. So what's happened is the quit rate, how the rate at which workers quit their job. That's really the ultimate sign of confidence in the labor market. Are you willing to quit your job? That's back down to pre-pandemic levels. That's fallen quite a bit. So workers intuitively know that the job market is tightened up on them, and there's not as plentiful job availability. And then you've also seen that in the wages that they've demanded. So wages have come down quite a bit from their peaks as well. And none of this is a bad thing. It's all just a normalization of trends that we had before the pandemic. Now, when I think about small or more specialized workers, there is definitely still a supply-demand mismatch out there in certain industries. And I'd be curious to hear what you guys are hearing from the veterinarians. But I know my wife is a nurse, for instance, and there is still just a plethora of nursing jobs open. They're just having a hard time filling it. So for a lot of the more specialized roles, and particularly in the healthcare fields, you are still seeing a pretty tough job market where there's a lot of job openings and not enough people to fill them.
Yeah, I mean, it's been interesting in vet. I think, one, thanks for coming on. I really appreciate you spending time with us. And I know that our listeners get a lot of value in having you explain some of these complex topics to them. But with respect to labor, I do think, anecdotally, what we're hearing is similar to what you're saying, is a kind of a more accommodative labor market than what we dealt with last year and the year before. On the specialized side, Travis looks into this deeply with the work that he does, but what you're seeing in veterinary medicine last year, and so it's gotten better on the staffing side, especially with doctors. You've seen operational efficiencies, getting more efficient with the way that these clinics are operated, which has helped alleviate some of the burden. You've also seen ticket numbers, so not size of transactions, but the number of people that are coming in drop a little bit over the last 2 years. If you look at the last 2 years, probably like 5% annualized, which is interesting. So that's kind of taking away a little bit of the burden, but they're remaining financially healthy because the ticket prices have actually increased. So, all those things combined, an easing labor market, lower volume, a little bit of operational efficiencies, it seems as though these employers, when they're going to staff, are in a much better place than they were 2 years ago. I still think there's room to go. I mean, I think everybody would agree on that. The veterinary industry is still in such high demand, but from what I've been hearing out there and all the data that I've looked at, it looks like things are improving, which is great. Travis, I don't know if you have anything to add to that.
No, I mean, I think I agree completely with you, James, right? There's certainly a softening, where I can't remember the stat, like end of 2022, how many openings there were. I mean, I think it was like over 7 or 8 openings for each doctor that was potentially looking for a position to, now people are actually, again, and this is all just kind of, hearsay. I don't have anything data, but people are at least saying, hey, people are engaging in interviews in the veterinary space, and there's at least opportunity if you are a hospital owner to find a doctor out there right now, which I think is positive and hopefully will continue to fill the need and the void that's out there. Again, you're still looking at the fact that the study that was done by I think Mars and VCA, that there's going to be 15,000 openings or 15,000 veterinarians needed to serve just the pet ownership by, I think, 2029. There's more than just economic factors impacting that.
Yeah, that's awesome. Thanks, guys. Tony, this has been awesome. Thanks for coming in. Really appreciate you spending time with us today. Hopefully by the time we do this next one, maybe we'll just have all of your content AI generated we'll have your voice come in, we'll have all your research come in, and then we'll just have you on autopilot on this podcast going forward. That could be kind of cool.
That sounds great.
Yeah.
Tony's like, that way I won't have to spend any time with you guys. Yeah, Tony, I'll miss you.
Tony's irreplaceable. You're never going to be freed from the podcast, Tony. All right. Well, thanks, guys. Thank you to the listeners who checked us out today. We're grateful for you and appreciate you, and we look forward to talking to you next time. Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signatureveterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content, and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of SignatureFD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which SignatureFD has no involvement or ownership. James Yost is a partner and wealth advisor at SignatureFD. SignatureFD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and SignatureFD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.